Welcome to Making the Deal, Frameworks for Your Transactions. This podcast is focused on lower middle market transactions and how to bring them to a close. I'm Sean Mercino.
And I'm Joe Allam. As a quick recap for everybody, I've been in the investment banking space for about 18 years, and Sean has been in the commercial banking space for about 10 years, and he helps provide funding solutions for his clients. Our backgrounds give both of us a pretty good background to be able to carry these conversations on transactions, how to bring them to a close, what all the important pieces are, all those kind of things. Today, we have our first guest with us, which we're super excited about. Today, we have Justin Hanna from Taft, which is a great law firm here locally and nationally. He's our first guest, so we're really excited to have him. He's going to get into a bunch of details today for us on some of the important topics when it comes to the various pieces of the transaction, which we covered last time. So with that being said, Justin, really appreciate you being here. Why don't you go ahead and do a little brief introduction with everybody?
Yeah, guys, thanks for having me. Grateful to be here. As you mentioned, my name is Justin Hanna. I am an M&A attorney and partner at Taft Law, typically focusing on private equity, middle market companies ranging anywhere with an enterprise value of 5 or 10 million up to 250 or so million, but we go outside of those ranges as well. And a lot of my clients are closely held companies, entrepreneurs as well, that are selling. They don't necessarily have a succession plan in place, so they want to sell to another strategic or to a private equity. And Taft Law, by the way, is a full service law firm. We have 875 lawyers spread throughout, 8 Midwest markets and an office in Washington, D.C. So we cover the full gamut of everything other than basically personal injury and criminal.
Okay, perfect. Well, thanks for joining us, Justin. Great coat, by the way. I wore a plain navy one today, and you outshined us. It's great to have you join us today, so thank you for that. Just a quick recap on our last episode. We covered all the steps that go through a transaction and bringing it from cradle to grave. So that's your LOIs, your proposal, your negotiations, your underwriting, your due diligence, your documentation, and then finally the close where Joe buys you drinks. So we covered all of that in the last episode. Feel free to shoot either Joe or I an email or a message on any of the platforms if you have any questions or want to engage about any of that content from last episode. So this week, we're going to dive into one specific area that requires a lot of attention, and it's really the foundation for transactions, and it's the roadmap as you go forward from the start of a transaction to getting it to completion. It's really important you give a lot of attention to these, and Joe and I will say it up front, very important that you engage strong, qualified attorney counsel for this type of stuff, just because
None of your friends who are not in the transaction world, please.
Correct. They might do divorce law very well, but do they do mergers and acquisitions well, like Justin does? So that's why we wanted to bring him on today. So those areas are the LOI, the term sheet, and the purchase agreement. We've kind of identified those as the piece that we want to spend a decent amount of time on, digging into the ins and outs, the do's and don'ts, best practices, and kind of what we're seeing in the industry today. So that's a big focus for us.
Yeah. And look, so as Sean said, we're going to cover 3 things today. We're going to cover funding term sheets, which will come up shortly. We're going to cover the letter of intent and the purchase agreement. All of this is going to be pretty tightly tied into an M&A transaction.
Right.
But obviously, like the funding stuff is going to apply to a normal transaction.
Sure.
There's a lot of stuff in there that we're going to cover that's going to, just for the business owner who's going to be running his company and taking in debt. So That being said, let's start with the letter of intent, which is the building blocks of any transaction, right? It gets you started down the line. Okay, so let's just start with like a couple of key provisions. So one, letters of intent are very basic. They are going to cover topics at a very high level, right? But there's a couple of things that are really important. So binding versus non-binding, and then exclusivity. So why don't you give us a very high level of kind of what's going to be covered in the LOI from those two perspectives.
Yeah, certainly. So as you mentioned, LOIs are very high level. You're not necessarily at a point where you're ready to start, negotiating specific terms because you don't have all of the information yet. But based on the information that you do have, you sort of set out guideposts for the transaction.
Sure.
So, you at least make sure that the parties are on the same page moving forward and that there's a prospective deal. But the real purpose of the LOI is, from the buyer's perspective, they want to make sure that if they're moving forward down this path, they're going to be spending a lot of money and time and effort and paying third parties, legal, accounting, etc. They want to make sure that the seller is not going out and shopping this deal to other buyers, right? So that they're not going to incur hundreds of thousands of dollars in fees only to have the deal pulled from underneath them. So they'll, negotiate some period of exclusivity, and that typically is going to be binding because that's the underlying basis by which they want to proceed with the transaction.
Right.
The other terms are just business terms, and those business terms might change after, there might be new information that comes to light. The company might not be performing as well as what, they had originally represented. So there's a lot of factors that could cause those terms to change, and that's why they're typically not binding. But they're, sort of the guiding principle that the parties proceed on. I see varying levels of exclusivity in these agreements. I think, what do you think? Like 45 or so days in your experience, Joe?
Longer for the bank, as long as you can go.
Yeah, I mean, it could be 60 days. It could be 75 days. I mean, it's deal specific. Sometimes they work in, automatic extensions.
Yep.
And if we're being honest from a practical perspective, if the parties are far enough down the line and they get past this period of exclusivity, they're either going to extend it or, the parties sort of understand that they're past the point of no return. And so, they're just going to continue.
Yeah, you don't want to start over with somebody else because that's a whole new process of unknowns that is going to be uncovered, right? And yes, I do agree. 45 days is typically what we aim for. And then we'll either do extensions if everybody agrees to an extension, or we'll just kind of continue down the path with the understanding that everybody's on the same page. Okay, so, and then on top of that, there's going to be different levels of detail in each LOI, right? So, like somebody might do a whole, 3-4 page LOI, which would be very intense, but typically like a page and a half, 2 pages, something like that.
It just depends on the deal. I'd say, if there's a private equity buyer on the other side that has done, dozens of these deals, they're going to have an idea of what they're looking at, what they're looking for, and what they expect. So that might have a little bit higher level of detail in it.
Sure.
Typically, if you want, I can get into like what's typically included, but I think that it's very deal specific. If there are issues that they already know of off the bat before getting really deep into diligence, those oftentimes will be addressed up front because you don't want to kick that can down the road if there's going to be a material point that could potentially,
Impact
be a
the
deal
deal.
killer.
Right.
Yep.
You want to address that up front. So that those details are in there. Sometimes I see some details on like reps and warranties. I see details on like specific employee related matters, but it's very deal specific.
Yeah.
Sure.
Okay, so let's start hitting then on some of these key provisions, right? Yeah. So look, most important, everybody wants to agree on this. What's the purchase price, right?
Yeah, I'd say that's pretty important.
Yeah, so obviously in the purchase price, there's a couple of different ways that can be broken out. Why don't you just kind of hit on the key ones that are going to be thrown in there in order to get to this is your final purchase price?
Yeah, sure. So typically, the buyers want to put the overall deal value on the top line. That's the first line in the LOI that talks about, okay, here's how much we're paying you for your company.
Yep.
And then once you read the fine print, it gets into, well, here's how much we're going to pay you at closing. Here's how much we're going to pay you at some point after closing, maybe some deferred portion or a note or something. And, potentially if you hit these certain metrics, then we'll pay you some more.
Yep.
right, in the form of an earnout. So that typically is, that sort of level of detail is included there, but they don't really get into the nitty gritty about how all that's, figured out. They might set, what the metrics are going to be based on, right? So
Right.
whether that's EBITDA or revenue or profits or units sold or, whatever that metric may be. But it just, it'll say, your purchase price is 20, we're offering you $20 million.
Yep.
15 of that is going to be paid at closing. $2.5 million is going to be paid pursuant to, some deferred purchase price. And you can earn up to $2.5 million in an earnout.
Yep.
That's how they sort of get the sellers to get excited about that $20 million.
And we're seeing them heavily used right now. And look, in our discussions with other deal professionals and investment bankers and all those kind of things, like everybody is saying seller notes and earnouts are very prevalent right now, just because, like, look, deals are. It's exactly it.
Right.
Rates are high, which means buyers want to pay less. Seller expectations are high, which means sellers want more money. How do you bridge that gap? It's a prove it deal, right?
Yeah.
It's something along those lines. So okay. So we've hit on the purchase price. What about the structure? Asset versus stock. That's usually a really big deal.
Yeah, so that's typically addressed up front in the LOI as well. A lot of times there are a number of considerations that go into it. I'd say generally speaking, buyers prefer, just at a very high level, buyers prefer asset deals.
Right.
You're not taking on the liabilities, or you're only, I should say, taking on liabilities that you expressly agree to take on versus an equity deal where you're taking on all the historical liability of that particular entity that you're stepping into the shoes of the equity owners. There's also a step up in tax basis that buyers get on asset deals that's a little different in equity deals. And then, there's some outside considerations that have to come into account as well. So, one of them is, what's the existing tax structure of the business that's being sold, the target company? If it's an S corp, then there likely will be some sort of either what we call an F reorganization or a 338H10 election that gets made. And that allows the buyer to acquire the equity of that underlying business, but it's treated as though, from a tax perspective, it was an asset sale.
Right.
And it's no longer treated as an S corp in and of itself. The other really big point here, and I don't want to, belabor the issue, but the other big point here is, in asset sales, there's oftentimes a lot of third-party consents that are necessary. So in connection with contracts,
Sure.
they might not be assignable without the consent of the other party. There might be regulatory.
And they have to be assigned, because in an asset sale, you are literally starting a new company. This is not a continuation. This is a new company, and it's not going to have anything besides what's being transferred over.
Right.
That's exactly right.
Yeah.
It's a new company. Might keep the same name.
Mm-hmm.
You might take the
DBA,
name. You
doing
might have
business as.
DBAs, but it's a new EIN. It's a totally new entity.
Mm-hmm.
So this contract's technically being transferred. It's being assigned. So a lot of times it might require consent from the other party.
Mm-hmm.
There are also regulatory consents, licensing issues. So all of these things come into play, and that's one of the very first considerations that the parties give towards how to structure it. And it, as information comes to light, it is possible that the deal, structure changes,
Right.
and the parties have to have conversations about that.
Yeah, we're sitting on an LOI that is actually right now saying asset or stock. Like they're just not sure. They need to do more diligence in order to figure out.
And that's fine, but from a seller's perspective, there also might be a difference.
Yeah,
Right.
So,
of course. Of course.
Part of what the LOI is, how much can you agree to up front? But if you can't, it's fine, because this document itself isn't necessarily binding, other
Sure.
than those binding provisions that we
Sure.
will get into.
Another question for you, Justin. You mentioned it when you talked about the stock versus asset and assuming what you know versus what you don't. A phrase that gets thrown on a lot: cash-free, debt-free. Can you maybe walk us through, your experience with that and what that means?
Yeah, certainly. So, and we can talk about this in a moment, but in connection with most deals, there's usually a net working capital true up.
Sure.
And, the buyer's buying the business. The sellers get to keep all the cash. That's
Right.
that the business comes with as an operating, going concern. But they also have to pay off their debt
Right.
because buyers, number one, it's really difficult to transfer debt. But number two, buyers want to step into the business fresh and clean. They have their own financing potentially.
Sure.
Their lenders aren't going to want to have any, debt on the books. So cash free, debt free essentially means you get to keep all your cash, but you have to pay off any debt or debt like items. So that could be, capital leases, things like that.
Okay.
And so that's what that phrase means. And that's the vast majority
Of deals.
of deals,
Right.
other than maybe, some distressed deals or, something along those
Okay.
lines.
And I'd just like to step in and say there are some exemptions when it comes to taking off the cash. If there's unearned revenue, like if you get progress payments, like that stuff, like that you could be taking cash from somebody, from the buyer, for money you've been paid for work that you have yet to complete. So there's, that can get very complicated once you start getting into those types of issues.
Sure, just because we say cash free, debt free doesn't mean that you're leaving the bank account with zero in like an equity sale.
Mm-hmm.
And it's in an asset sale, it's a little different because the buyer is setting up a totally new account because it's a new company. But in an equity deal, the buyer's getting all of the business's accounts. Doesn't mean that you clear those out, totally wipe them out.
Mhm.
But at the same time, buyers don't want to pay for cash.
Yeah.
Right.
So because they're pulling, financing or they're getting equity commitments in, and
They're
they don't
paying
want
for
to use
that.
those to fund cash that has to go to the seller anyway.
Yep.
Right.
So there's some amount that stays in there just to operate the business, but for the vast majority of it, I mean, even the amounts that get left in actually get paid out to the seller post closing.
Okay, now you touch on the working capital adjustment, and this is a big piece of the puzzle because personally, I find this to be the biggest negotiation outside of like the actual purchase price. Because it can create such a major swing in the transaction, or in the actual cash. So why don't you jump into a little bit of an explanation about what the working capital adjustment is? And how it actually affects, how you negotiate it, how it affects all those kind of things.
Certainly. So, from a business perspective, from the business folks' perspective, the biggest points in any deal are dollars and cents.
Mm-hmm.
And that's what the net working capital is. It is literally dollars and cents. It's at its very simplest. The calculation is current assets minus current liabilities.
Mm-hmm.
Sounds really simple.
Keep it simple,
Not,
right?
Yeah, right.
not quite that simple, but basically the buyer wants to step into the business at a normalized level of working capital that the business averages over some period of time. So they might, take a look back, typically, let's say 12 months at the business, and get an average. And that average is going to be a target that gets set, and at the closing, the company's either at, above, or below the target based on what seller estimates,
Sure.
Mm-hmm.
if there's an estimate delivered. And then at some point post-closing, 90 days thereafter, the buyer actually runs the numbers and delivers a report to seller saying you actually were this much over, this much under, and then there's a true up.
Mm-hmm.
And the purchase price gets adjusted based on the overage or the underage, and it results in either an extra payment to the sellers or a payment to the buyer, actually, because there wasn't as much working capital as the sellers thought there were.
Yeah. And in simplest form, it's like the buyer is either ending up with more assets or less assets. If it's more assets, the seller gets more money. If it's less, the buyer gets less. Yeah. Anyways.
That's exactly right. And the only thing that I'll say here is at the LOI phase, the buyer doesn't really necessarily know what the working capital should be. They're still going through their diligence. They're going to do a QOV, quality of earnings report,
Sure.
Mm-hmm.
To figure out what the quote unquote true numbers are. That takes some time. It takes some, information being provided by the seller that they don't have yet.
Data room, our favorite. Data room.
Exactly. So You know, what I often see is just, the company is going to deliver a normalized level of working capital to be determined by the parties. I mean, keeping it very basic, but that's essentially the LOI phase. That's really what it talks about. And then once the parties get into negotiating the purchase agreement, then you really get into the nitty gritty.
Mhm. Love the definitions in there where you start getting into all that stuff.
Right. Right. Justin, a question for you as we talk about the LOI. From a lender's perspective, a big topic right now when we're going through these transactions and the transition, right, from the baby boomer generation to the next generation of ownership is transfer risk. And a big part of that is who's managing the company, who's operating. How deep do you get into with employment agreements when it comes to the LOI? Is that just kind of a bullet point, or do you guys dive into it?
I'd say it's somewhat deal specific.
Okay.
You might be talking to sellers that are totally ready to retire, and you know that going into the transaction. So you're either going to get nothing from them, or you might get some, very small level of transition service, maybe in the form of like a consulting arrangement.
Right.
But a very big portion of transactions, the management team is critical to the
Right.
business, because if you have a private equity buyer, just as an example, they don't know the business.
Sure.
They might, high level know the business. They don't know how to run the company.
Right.
So the management team in there is oftentimes what the buyer is actually looking for. It's management team, customers, and finance. I mean, that's what the buyers are looking for. So if they know that off the bat, and there are specific people that they expect to stay on, you can be sure that that's going to be in the LOI, at least just mentioning the fact that the buyer expects X, Y, and Z person to
Right.
sign an employment agreement that's mutually agreeable to them and to the buyer.
To the depth that they know early on, because to your point, right, they might only have exposure to a certain amount of that on the front end, but it is included, so that's good to know.
Yeah, and if not, I mean, oftentimes what I'll include is just sort of like a generic line that says, the buyer expects that key management employees will sign employment agreements satisfactory to the buyer.
Okay.
And sometimes that means they got to incentivize them too, right? To stick around.
Exa-
Retentions.
Exactly, and a lot of times buyers can be concerned that once the employees find out about the deal, they might be out. So,
Right.
There's also sometimes
So
language that
delicate.
it's a fine line to thread, and certain companies are more sensitive to that sort of topic than others. But there's sometimes language that we build in around that to make sure that, there aren't huge depletions in the personnel of the
Right.
company that, sort of defeat the purpose for doing the transaction.
Yeah, that's super important. Look, I almost had a deal blow up over it last year because they didn't tell the employees until they had already signed an LOI and were like into due diligence. And the buyers came into town and they called everybody into the conference room. Half the room got up and walked out. So
Wow.
you can imagine it's a big piece of the public. Look, people just don't think about the fact of how important people are to the business. They're like, look, I got a company that's making X, Y, and Z. We've got these great customers, we've got these great contracts, blah, blah, blah. You can't perform on those without the people, right?
Who's
so that was a
executing?
great,
Who's executing, right? It
Yeah.
could be the secret recipe, the owner has it, but who's executing it?
yeah, that was a great point, Sean. Okay, so from there, you're going to get into your diligence period, right? So, we typically see it about 45 days. What do you?
Yeah, I mean, we see, I'd say on average 45 to 60 days. I've seen longer and I've seen shorter. A lot of times people are very hopeful, or they might sometimes just intentionally negotiate a shorter period because they want the parties to move quickly, knowing that they're not necessarily
Right.
going to hit that timing. But as we mentioned earlier, I think that as long as the parties are proceeding and are far enough down that road, it's still possible to extend that once you get to the deadline. If you need an extra 10 or 15 days, nobody wants to start that process over. So
Sure.
it just makes sense to do that, or just to operate, at that point without the exclusivity, because it's not worth it for the seller to go to anyone.
Yeah. Okay. And then, there's always a normal course of business provision, which means like, hey, don't collect down your receivables and build up your payables, right? Like you gotta you got to operate the business the way you've been operating
Right.
the business. So you can't deplete the business, to your point earlier. Okay, and then lastly, governing law. So, if it's in Michigan, we typically like a Michigan venue. Sometimes buyers are out of state, so they might want to negotiate something different than that. I mean,
Yeah, I mean, if you have parties from multiple different jurisdictions, a lot of times you'll see Delaware thrown in there because it's what I'll call like the gold standard of corporate law, and their courts are very well equipped to deal with any issues that can arise. But if the parties are located, buyer and seller are located in the same jurisdiction, we'll call it Michigan, then that's typically pretty agreeable. And from the target company's perspective, they oftentimes want to go with wherever they're located. And so that's just something that gets negotiated a little bit. The other thing that I'll say about LOIs before we wrap up this section is, if there are specific issues that get identified right off the bat, you'll see those included. You'll see those, like we mentioned, negotiated off the bat. They'll talk a little bit in LOIs about definitive documentation, so the purchase agreement itself. And in that language, oftentimes you'll see specific call-outs to reps and warranties that the parties intend to have be fundamental, so not subject to baskets, caps, which we can talk about later. But
Sure.
Sometimes that gets negotiated as well. And then like I said, anything specific.
no, that's a really good point.
That's a good way to cover kind of the LOI from a high level, right? The key parts. Pivoting to term sheet. So what is a term sheet? What is its purpose? So from a lender's perspective, the term sheet is issued to the buyer of the company. Sometimes we're involved with the seller. If we know the seller closely, we can assist them in offering some kind of term sheet to a potential buyer. But in this situation, we're talking about issuing a term sheet to a buyer who we have in hand. It really outlines the nature of the deal. So the senior financing could be a piece of the overall transaction. It could be the lion's share of the transaction. It outlines the loan amounts, what type of loan facilities, right? Is it just the transaction financing? Is it equipment financing? Is it working capital financing kind of out of the gate? So that term sheet, similar to the LOI upfront, will have an amount, what facilities, and then it's going to get into the details of the facilities. How long of a term are these loans? What kind of amortization are these loans? So kind of outlining that. And then you're going to get into, well, what kind of collateral do we have for these lines, for these working capital lines of credit, for these transaction financing? Is it equipment? If so, we need evaluation or appraisals. Is it real estate evaluation or appraisals? Anything like that on an ongoing basis for a working capital line? Are we going to need annual audits for inventory and accounts receivable? All of that's going to be outlined in the term sheet. You're also going to see personal guarantees. Is that a part of the structure? If so, is it limited? Is it unlimited? Is it secured or unsecured? Each transaction has a different profile. We mentioned the private equity deal. Often there's not a personal guarantee associated with that. More than likely there's not. In a strategic situation or a generational transfer, right? Sometimes there is a personal guarantee to have the owner have skin in the game, the new owner. And the term sheet's also going to outline costs. So we talked about collateral, any kind of evaluations, any kind of appraisals, any kind of ongoing monitoring that's needed. It's going to outline those costs. It's going to outline if there's a line of credit being put in place, is there an unused fee for having that line of credit available? Is there going to be any closing costs, origination fees, anything like that? That's all going to be outlined. And then the fun stuff, you're going to have covenants outlined, from an ongoing basis, what is going to be required of the borrower. So that could be, if it's a leverage covenant, a cash flow covenant, there's a variety of different covenants, but the term sheet will outline that. And then also, it's going to outline subject tos. So what does the bank need to get to a close? And often that is a handful of items that takes a bunch of parties' involvement to get there. That could be completion of a Q of E. That could be completion of the PA, signed from both parties. It's a variety of entity documents ready for close. There's a lot of subject tos, and each bank is different on how they they list that out, but more often than not, you're going to see a healthy list just because the bank wants everybody to be aware of what they need to sign the documents to get to close so Joe buys drinks after the close. But that's kind of from a banker's perspective, the term sheet has all of these different things lined out. And it's important for the buyer to feel comfortable with that and engage counsel early, right? Justin, I don't know if you have any thoughts on that.
Yeah, I mean, look, I think obviously it's very important for the parties or for the buyer and its lender to have, similar to the LOI, to have the baseline by which they intend to proceed, right?
Sure.
So that there aren't, things that come up after the fact that's like, whoa, I didn't have that
Right.
expectation. From my perspective, totally important to get, counsel involved early on. We're going to be quarterbacking this entire process between, the buyer and if we're representing the buyer, we're going to be coordinating with the lenders. We're going to be coordinating with sellers counsel. If it's a rep and warranty insurance deal with the insurer, I mean, there's a lot of different parties that we're, sort of working with. We want to make sure that we're managing expectations. We want to make sure that we're managing timing, that timing aligns
Sure.
with all of the various parties. And, at some point we'll need to review the loan documents. And even on the smaller loans, that might be using Laser Pro documents, there still might be some comments that, we have that may or may not be able to, be incorporated in one form or another. But if it's, more substantial loan documents, then at some point we're going to need to review those in depth. And so having an understanding what the term sheet provides for and making sure that that's consistent with what the documents actually reflect it is critical. And I would say, just like diligence as a part of the transaction process, the earlier that we can get involved, the better we can help coordinate that process.
Yeah.
Sure.
Yeah, and look, Sean and I talked about it in the last episode. Like, I probably understand most every issue that's going to be brought up. I certainly shouldn't be the one documenting it. Like, I shouldn't be the one that's giving you legal advice on those things, and neither is Sean. Like, you need your attorney to really be guiding all of those items because there's so many intricacies in so many different areas here. Like, you need somebody who can do this appropriately, and they should be part of all steps of this.
Right.
Like, there's no way. Can you get through it? Maybe. Are you probably going to get take advantage of? Probably.
Well, just because you don't know what you don't know. Right?
Yeah, right.
Exactly. You don't know what you don't know. And you never want to be in a position where there's a technical default where the parties don't really care about the default.
Sure.
But if, push comes to shove, let's say the economy's in a downturn, banks are looking to call loans. If they have a reason to do it, there's this technical default that exists there. Mm-hmm. Now you're in trouble. Well, I try to look out for those types of,
right.
hang-ups and issues. And, I just use that as one example.
Yeah. No, that's perfect.